Good evening, everyone. Thank you all for joining us for this webinar. I'm Saket Kumar, co-founder at ETF Junction. Let me share a brief on ETF Junction and what it does. It's basically a fintech platform which intends to provide a complete ecosystem for the ETF industry, which involves all the stakeholder, which is manufacturer, ETF service provider like stockbroker, investment advisor, RIAs, finfluencers, and above all, the end user, which is investors in India. The endeavor is clearly to solve the underlying challenges which is being faced at this point in time of awareness and also the proper infrastructure on ETF uh, in the industry and create a platform for very smooth and inclusive growth, as we say, for the growth of ETF in the country. It's indeed a pleasure to welcome you all to an engaging session on passive investing. This webinar is being presented by ETF Junction's ETF Pathshaala, which is a wing of ETF Junction. This webinar is being largely to showcase and to you being used for educational purpose, and would like to share that ETF Pathshaala is a forum for sharing valuable insights on ETFs and passive investing from the different industry experts and the experts from the subject itself, the eminent speaker in the field. So this is being conducted on a regular basis on a month. I'm sure you would have been watching on a every month basis. Now, coming directly to the topic of the webinar, relevance of passive investing in investment portfolio today. We look forward to understand the world of passive investing and how it can make an impact in any investment portfolio. Now, to set the stage, if you look at, I think Indian investing scenario has dramatically changed, and it's been pretty dynamic in nature of late. Active strategies have seen an unparalleled growth, right? From roughly around a lakh of crore in the total AUM in early 2001 to right now as we speak, last number, a month's number has been roughly 52.85 lakh crore. That's amazing growth, unseen, unthought of, right? And as we are seeing, this is one side of story. But if you look at the other newer pasture called passive, we see a lot of green shoots out there, right? So without further ado, let me first introduce the eminent panelists we have for today's webinar. The first on the guest we have is Mr. Shravan Goyal. He's the head passive strategies from UTI Mutual Fund, the father of mutual fund in the country, as early as 1964. So Mr. Shravan Goyal is a he's heading the entire passive arbitrage and quant strategy at UTI AMC. As you can see, he's a CFA chartered holder from CF Institute USA and also holds postgraduate degree in management, MMS from Wellinger Institute of Management. He has over 16 years of experience in risk management and equity research, portfolio analysis, and fund management. One of the pillars as far as the entire Indian industry is concerned. Great to have you, sir, with us. Thanks for being there.
Thank you, Saket, for inviting.
The next in the list we have is one of the very bright, I would say, very rare erudite scholar, I would say, someone who has seen 40 years in the financial field and has been spearheading the investment management roughly for 30 years. Top ranker across SSC, LLB, Chartered Accountancy in 1982, was also the award winner in CNBC TV 18. So that's a very, very prestigious award. And now has got strategic tie with Scriptbox. So we feel really proud to have you, and such brain, I'm sure, is going to enlighten all of us in this evening.
Thank you, Saket. Just one correction. People like Shravan are in the investment management business, and
right.
I am in the investor management business.
Great. That's even tougher, I would say. So that's even tougher, I would say. I've been seeing the industry for 25 years. Thank you so much. Thank you so much. The third, we have Koel Ghosh. I'm sure all of us have heard someone who has been really I think, sparking light for last almost 2 decades, have been in the industry. Someone who has really struggled it out. Now we're talking about passives, ETFs. Someone who has really broken a lot of ice over pushing things and getting it done. She was earlier heading, I think, very prominent positions at different if you can just see at Asia Index, she was heading South Asia, S&P, Dow Jones indices, along with driving growth for Asia Pacific Private Limited. And also she has been an integral part of the mutual fund industry, had a small stint at UTI Mutual Fund, at ILFSS, and we are indeed proud to have her as a part of the journey which we have undertaken. So this is largely about the entire evening which we are just going to spend to understand how they can collective share their entire wisdom and enlighten us this evening on the realms of passive investing. And would request all the participants who are hearing to keep their questions ready whenever and whatever comes to their mind, which could be answered by these luminaries which we have, the same would be answered at the end of the session once we complete this, right? So that is largely, as far as the panelists is concerned. Now coming to the questions as we have, right? If you look at Indian industry has seen a fabulous growth. As I was just saying some number, but if you look at in totality, what has really happened is that there is a big graduation, and the key to see is that from fixed assets, which was land, largely traditional investment, and gold, has started shifting to the real financial investment. That's very, very heartening. And we have seen active really taking the center stage and adding big numbers. We are seeing green shoots, as I was sharing, right, which now constitute roughly around 17% of the total 52.85 lakh crore industry. Now that's very, very early days. And if we see how global market has shaped up, it's roughly around 54% passive than active, which is there globally. So that's something which is clearly giving us a sense how things are going to move from here. And if you look at, we have Koel who can just share with us, the question in this context, just to set the context right, for a lot of new investors who are part of this this webinar would like to understand what is the core concept of passive investing. How does it differ from active investing, which they have seen to some extent? And also, Koel, from you, if you can just share an overview of how passive investment strategies work, right? For this, something which is very new to the investing. Koel.
Yeah. Yeah. Thanks, Saket, and it's always a pleasure to be here. So passive and active investment have always been at loggerheads with each other. There's always this debate, should one do passive or one should do active? So let's first of all understand and, like you said, set the stage on what passive is. Passive is nothing but, not active, right? So when you go into the active space, you're actively selecting the stocks that you're investing. Right now, some mutual fund where you have active strategies going on, they will, in a large cap say fund, where they will actively select stock based on research. There's a team that's doing research, and they, according to the investment objective, will cherry pick stocks based on what they are trying to achieve through an investment goal. But the passive is not actually like nobody's doing anything. Yes, a fund manager has lesser work, but what he has to do and what Sharwan has to do is select the right index and ensure that he replicates the index. So if I have 100 rupees with me and I want to invest in the Sensex, which is 30 stocks, I can actually invest in 30 stocks with just 100 or 500 rupees. And that's through an index fund or an ETF, right? So that's your passive fund. Now, if I had to explain that in a more simplistic format for a layman who doesn't understand, say, I don't understand financial markets, I get that a lot. Say that, the stocks and finance, I don't understand. So, yesterday just was Valentine's Day and everybody was gifting chocolates. So if I had to do an active and passive comparison, an active would be where if I know that, a friend of mine or somebody whom I want to give a Valentine's chocolates to is somebody who likes mint chocolates and almond chocolates, but does not like, dark chocolate. I will do a mix of everything, but I'll leave out dark chocolates. I will do white, kind of milk. I will do almonds. I will do anjeer, and I'll make a box. But for let's flip on to, that's your active. Let's flip on to what a passive would have looked like. Now you have a lot of Taj boxes, or you have delicacy, you have a lot of other, say Cadbury's, which is a very well-known brand. They have preset boxes. No thinking, you know that it's a nice packaging. You just go pick up, you want a box of 10, you box 12, 15, whatever you bought, you pick it up and you go. So that's your active versus passive. Now, why is there so much of a prominence? Now, I think it's a very, very valid question for beginners. I always, feel, and I have always personally recommended and felt, because they can't really recommend, but it depends on each person's investment profile. And Bharat will talk more about, how financial planning comes into place. But if somebody really started their journey into, experiencing or sampling the financial markets, a passive route is very good because one, you're getting a diversified basket of just not one, but a couple of stocks. Two, they are actually very, very low cost. They are comparatively a much lower cost to the active funds. The active funds have a expense ratio of 1 to 2%, depending on how they are structuring their investment portfolios, where passive kind of options can go down as low as 1 basis point or 2 basis points. So it depends. Again, each product has its own expense ratios, but that is something one needs to be very, very careful about when you are looking at passive. The huge advantage is low cost, and then of course there is liquidity. It trades like ETFs trade like a stock on the exchange, so you can get in and get out at any point of time. Liquidity is not an issue. If you want liquidity for your investments, you can actually invest in ETFs, and that makes it a much, much more better proposition. So what better can you do? Low cost, liquid, diverse, and independent, because it's based on an independent index provider's index. So the UTI Sharwan does not make the basket. It is made by independent product providers like BSC, NSC, there's S&P, there's MSCI. So you have an independent who has no interest in the underlying product, but he just wants to create an index that represents either a market or a factor or a theme. So that's where the strength of passive comes along, and it provides a great gateway if you want to start experiencing and sampling market-based returns.
Thanks, Quell. Very interesting. I think similes, assorted pre-packed assorted chocolate boxes are a replica of what we are talking about, right? As far as the passive is concerned. Thank you so much for giving a good understanding for our new investor and setting the stage. The second question is from Mr. Shravan Goel, and if you look at just share some of the data, that India has roughly around 13 crore Demat account, and it's been growing like with a rapid pace, with a unique 8 crore investors as of now, right? Now, if we are going to see on an average roughly 20 lakh, right, is the total SIP month on month which is coming in mutual fund, right? Numbers we are all aware. 25 lakh Demat every month on an average. In some months, 35 lakhs, 40 lakhs as well. Given the trend, by most conservative estimate, we will be able to add next 8 crore unique investors in equity market, right, by roughly 2027. And approximately 30,000 crore coming every month, of which 18,000 crore is just the SIP number. You have PPF, provident funds, right, and pension funds, and annuities coming from insurance and all that. So it will add up roughly $100 billion of domestic flow every month by 2027. That's the strength of retail. So, Mr. Shravan, the point is that, with this kind of inflow, where do you see the current market landscape, leading into the passive? So what factors make it right for the adoption and growth of passive strategies in India? Because such humongous money coming in, how is it going to make entry into these segments, right, which are these strategies? Can you also highlight the key shift or the trend which an Indian investor perceive and are approaching as far as passive is concerned? Mr. Shravan.
Sure. Saket, as you rightly mentioned that we are witnessing phenomenal growth across various mutual fund products. And we are witnessing, in fact, far faster growth in passive business. Passive funds used to be little less than 1% of mutual fund industry about 10 years back. And in 10 years, it has become almost 16 to 17% of mutual fund industry's AUM. And in terms of absolute AUM also, we have seen phenomenal growth from just about 10,000 crore rupees. Current size of passive funds is more than 8 lakh crore. So we have seen almost 100 times growth in last 10 years for passive funds in India. So passive funds started picking up in global markets such as US about 2, 3, 4 decades back. Generally, whenever markets are initial stage of development, initial growth is driven by active funds, because somebody needs to handhold you for advisory purpose. But once people become aware about the benefits of these low-cost solutions, low-cost effective solutions, then the pull factor comes into picture, and we have seen phenomenal growth in passive funds and industry in India. So there could be wide bouquet of products available for investors within passive funds, just like active funds, which offers diverse products. In passive funds also, you get funds across large cap, mid cap, small cap, based on market capitalization, wherein stocks are selected based on the size of the company. Then we have thematic and sector funds, wherein stocks are selected based on a particular theme or sector, say manufacturing, consumption. These are some of the thematic funds. And then we have sector-oriented funds such as banking ETF, IT ETF, healthcare ETF, which offers you a bouquet of products for a particular sector companies. We have witnessed phenomenal growth in new kind of investment solutions, which are called smart beta strategies, wherein stocks are selected based on certain performance factors. For example, in the sense, these smart beta funds could be constructed based on certain fundamental factors, which are also tracked by the active managers, say quality, growth, value, or these or they could be based on market factors such as momentum, low volatility, these kind of categories. So there are wide bouquet of product available for investors to choose from for active and passive funds. And I would say both active and passive complement each other. So they are not competing each other, but they are complementary strategies, because both of them play a role in an investor's portfolio. So I would say investors should take advantage of both active and passive funds for their long-term wealth creation journey.
Thank you, Mr. Goyal. Thank you so much. Very nice. Now, next question is to Mr. Bharat Pathak. And if you look at, as of now, last 2 years have been a fabulous run, right? Last year itself, when we speak about the calendar year 2023, the total collections has been roughly 1.62 lakh crore. 1 year prior was roughly 1.61 lakh. This is the total mobilization of AUM which the industry has seen. It's the other fact that last year the index itself has gone up by 35% approximately. But the key to see that the participation of the retail has become a very strong force. And if you look at the total number as I just shared, 40% has come from the new fund offerings. Investment into mid, small, and thematic, as Mr. Shravan himself was sharing, has been roughly 60%. Now, this is where the part of retail investor coming. Now, as of now, they have not been a big participant in the passives. So, Mr. that reference, right? In advocating passive for investing, right? What empirical evidence or data are there? Some clear-cut, data which shows that there's a fair bit of for the retail investor to make money in this segment, and what factors should investor consider by evaluating a particular, strategy, and here passive strategies.
Yeah.
Mr. Bharat.
Yeah. Am I audible?
Yeah.
Thank you. So let me just set the record straight to some extent on understanding what is active and what is passive. So because there can be a misconception that if I trade often, I'm an active investor, and if I buy something and hold for a long time, I'm a passive investor. The real meaning of active is that I will have weightages in the portfolio which are different than an underlying index. So I can say that I will retain the same sectors, the sector weightage I can reduce or increase. Then within that sector, I can choose stocks which are different, or I can give different weightage to those stocks. So if I say my fund is in the banking sector, I want to give more weightage to State Bank of India and Bank of Baroda and less weightage to HDFC Bank and Kotak Bank. Then I am an active investor. So active does not mean churning. I think that is one thing which I would like to take to most.
Fair point. Thank you. Fair point.
Yeah. So it is the portfolio churn which will decide whether you are active or not is not the right idea. It is the weightages which are different, and the expression that he's saying that something in the index needs a higher weightage, something in the index. So it is the deviation from the index which will define an active investor. Now, obviously, there are many fund managers who are trying to do better than the index. So index is the benchmark, and I want to do better than the index. I think it is very important to note that in the US, a very large percentage of participation in the stock market itself comes through mutual funds. So if mutual funds own 50-60% of the market capitalization, then 60% cannot outperform 100%. But in India, if we look at the market cap, which is little over $3 trillion, which is the size of our economy, if you look at the share of the active funds, it will be still less than 15-20% of the market. And I think the possibility for active funds to continue to outperform for some more time, maybe 5 years, maybe 10 years, may exist when the penetration, even after the SIP flow of 16,000 crores a month, is only 15-20% of the market. And here again, Indian promoters typically like to hold 40, 45, 50% of the holdings. So to that extent, this outperformance is possible in India for some time. But like you very rightly said, this window may become smaller and smaller as we go along. And that is where index tracking funds, which is the passive definition, the way I see it, that I'm not here to beat the market, I'm here to meet the market. So as long as I can replicate the index with as low tracking error as possible. And I think the index fund manager is one of the most disciplined fund managers in the space, because he will change his portfolio only once in 6 months or only once in a year. When the index changes, he has to change his portfolio. Of course, he has to reflect corporate actions, etc. But so you know what you are buying and the underlying weightage. So I think as we go along, passive will challenge the active part, saying that are your fees justified? Are you earning your lunch? And how are you? Why do you need so many analysts? Why do you need so many people to take a call? I am just following the index, and this has been an escalator which has been going up for the last 40 years and possibly will continue to go up for the next 20 years. So if I just stand still on the escalator, I will make money. I don't want to jump down all the time trying to take active bets.
Thank you. Thank you so much, Mr. Bharat. I think very nice. I think punchline you gave, passive is to beat, not to beat the market, but to meet the indices or benchmark. That's nice. Very good. Thank you. Thank you so much. Coming to the next question, Koel, if you look at, cost advantage, as Mr. Bharat also said that, why should you pay more, right, if it is not beating the indice of the benchmark, right? So the question to you is that expanding on the cost advantage of passive investing, how specifically do lower cost impact investors overall return, right? Is this the only thing, or are there some hidden costs associated which might not really give him or her the advantage of passive investing? Go ahead.
Yeah, I think I agree with you, Saket. I just love Bharat, what you said, that it's not to beat the market but to meet the market. I think I'm going to definitely use that in my future conversations, because it's sometimes it's a real challenge to explain to investors the benefit what passive investments brings to the table. One of the things while I'll get to the question that you asked, Saket, what Bharat said, that there is this misnomer in the market that there is still this scope to beat the market, right? But more and more statistics and research is proving that that is no longer happening. Definitely in the large cap space, you have more than 70 to 80% of active fund managers, or active funds rather, who cannot beat the benchmark. So it's such common sense that if 90% of the active funds that are there today in the market are unable to beat the basic benchmark, why not invest just in the benchmark? Because the benchmark is beating the active fund manager. So you're definitely getting that benefit of alpha over the active fund managers today. So we are not talking about alpha to the benchmark, we're talking alpha to the active fund managers. So there you go in terms of one advantage that passives have, right? So you already definitely, in terms of your investment goal, edging onto that. Now on cost, there is like I already shared it in the beginning, there is a huge differentiation in the cost element. And if you see over time, that cost will also keep compounding into your return. So every basis point that you keep giving into an active fund manager's kitty, is that cost that you're that kind of return that you're taking away from your investment. And so I think that is where the essence is, and that's where your cost saving comes into it. One of the other aspects which Bharat also alluded to is, how do you, it's about replicating the index. How close are you to the index? So one of the things when you are investing into passive investment is you have to keep a close eye on the tracking error. The tracking error is the deviation to the index due to some cash management issues or trading kind of timing, etc., that happens when the fund manager is buying and selling and kind of doing the trading on the portfolio. And I'm sure Sharvan can explain more on that. But tracking error becomes a much is a good element when you're comparing passive funds. But when it comes to active versus passive, I mean, I am a very clear advocate of looking at the passive space. But we've had discussions on this ETF platform itself that it's never a choice between active and passive. You can actually have, there can be a harmonious tying of the two into your portfolio through your core and satellite strategies, where depending on where you are biased. So if I like passive strategy, I will put more percentage of my investable surplus into passives, which means that I will be replicating an index. It could be just market index like a Sensex. It could be sector. It could be, like Sharvan alluded to, factor based, which is like low volatility or momentum or value or quality. These are the very newer aspects which give you maybe a differential return to the market return. So you have a plethora of options within your passive space as well. So you can create your portfolio with passives as well. So again, the advantages in terms of cost saving, in terms of liquidity, in terms of diversification, I will keep saying, gives you a huge opportunity to invest in broader baskets across country, geographies, themes, and rather than doing an active strategy which could limit yourself when you're talking about direct. And also when you're comparing yourself to where active funds are not able to kind of meet the kind of benchmark performance that is currently being done.
Thank you, Gwen. Thanks for elaborating that entire cost advantage to our customer, to our investor here, and especially the fresh breed of investor who's yet to start the journey. Now, the next question is from Mr. Shravan Goel. And if you look at, I think, this is general saying that don't keep all your egg in one basket, diversify. And also, I think Mr. Shravan shared that, active and passive, which makes a lot of difference. One has to have both side of, flavor to add to the overall portfolio. Mr. Shravan, how do you see that, passive investing can contribute to the overall diversification in an investor portfolio? And what are the risks which are inherent? For a new investor, he should be aware of where can he go wrong and what can go wrong. Also, some insights into how passive strategies can really manage those inherent risks. Mr. Shravan.
Sure. See, Saket, passive funds follow disciplined approach of investing, right? So, for example, if you are investing in, say, Nifty, Sensex, these, in the sense, ETF or index fund based on these indices, then you have to study how these underlying indices are created, right? Because whenever you are investing in any passive funds, you are investing in underlying index. So just like active funds wherein plethora of options are available, within passive also there are wide bouquet of products. In fact, currently there are funds based on more than 50 indices, right? So first time investors should begin with simple to understand market cap oriented indices. So for example, Sensex, Nifty Next 50, these are large cap oriented strategies, large cap oriented passive funds. Somebody who wants to get a flavor of, say, mid cap, then he can choose to invest in mid cap oriented passive funds. Similarly, small cap oriented strategies are also available. So these are market cap oriented strategies wherein stocks are selected by the index provider based on the size of the company. So Sensex, in case of Sensex, top 30 companies listed on BSE stock exchange are selected, and that particular portfolio is rebalanced on half-yearly basis. So if you are investing in a large cap fund, say Sensex or Nifty, you are investing in top 30 or top 50 companies listed in Indian exchanges, right? And you know that these large cap oriented funds or large cap oriented indices are available for more than 2-3 decades. So you know the track record of these indices, that Nifty or Sensex have delivered close to 15% annualized return in last 20 years. So investors should understand the role of asset allocation in the portfolio, right? Generally, we directly jump into selecting certain active funds or passive funds. So you should first build your asset allocation. Once you decide that X percentage of my money should be in equity oriented funds, then within equity funds, you should choose how much should I allocate to core part of my portfolio, which is market cap based strategies, say large cap, mid cap, or small cap, right? Certain proportion of your fund could be invested in thematic or sector funds. So if you believe that, say, banking funds are banking sector has gone through tough time in last 2-3 decades, although health of balance sheets of Indian banks have been improved in last 2-3 years. So these banks are available at attractive valuation as compared to historical average. So if you believe that banking sector is here for good time in next few years, then you can add on to your exposure in certain thematic or sector indices such as banks. So similarly, one can look at investing in IT or any other sector which you believe that is going to be in a run for next few years. Similarly, as I've alluded, new kind of investment products are available these days, which are called smart beta strategies. So these are factor-based indices, wherein stocks are selected based on certain performance factors, say quality. Somebody who believes in quality investing can choose to invest in quality-oriented smart beta strategies. Somebody who is value-oriented and believe that I would like to invest in companies which are available at low price to earning ratio or attractive valuation, he can choose to invest in low vol strategy. Somebody who believes that I want slightly defensive strategy, I don't want to take aggressive risk, then he can choose to invest in strategies which is based on low volatility. Or somebody who believes that markets are trending, in the sense next 2-3 years market trend will continue for some more time. In that case, he could choose to invest in momentum based strategies. So within passive also there are wide bouquet of products just like active funds. So you need to mix these strategies, both active and passive. I would say one should not compete with active or passive. These are I would say two sides of same coin. These are complementary strategy. So one should mix all kind of strategy based on the thought process and investment journey one investor is having. Typically, passive funds offer low cost solutions, right? So typically expense ratio of passive funds is minuscule part of active funds. Active funds expense ratio hovers between 1 to 2%, while passive funds are available at as low as 5 to 10 basis point as well. So which means you are saving 1 to 2% every year. And in the long run, this 1 to 2% better compounding adds up to your return. So for example, rupees 10,000 SIP over next 20 years compounded at 10% becomes 76 lakh rupees. But the same SIP, if it is compounded at 2% higher at 12%, then your corpus becomes 99 lakh rupees in 20 years. So this 2% better compounding adds up to a lot of returns, right? So investors should be wary about which kind of strategy one should be investing. And my advice to investors or young investors would be, you should not be chasing returns, themes or funds which have done well in last 1-2 years, because the cycles keep changing. Funds which, for example, last 2-3 years, value oriented funds have done much better as compared to quality or growth oriented funds. Next 3 years, maybe the styles could change and quality and growth oriented strategies could do well. So these strategies keep on changing. So one should not keep flipping his or her exposure on yearly basis or half yearly basis based on previous 6 month or 1 year performance. One should invest in equity markets from longer term perspective.
Thank you, Mr. Goel. Thank you so much. Clearly, I think the take home here is that one has to have a broader diversification and use all strategies as shared by our panelist, Mr. Swan Goel. Clearly, I think this is a great learning for the participant out here. Getting to the next question, as I just shared the number, for the last year, roughly 1.61 lakh crore of mobilization last calendar year, Jan to December, mid cap and small cap and thematic, right? We're really riding the show, and they were roughly 60% of the total money which came in. I think the important point, and also I think Mr. Pathak shared himself that, right now, next 5 year, you will see active converting to passives and market, the moment it become efficient, which has happened in global market, clearly that scale tilts and, scenario changes. Now, For Indian investor, Mr. Pathak, right? If you look at what are the specific sector or thematic areas where passive investing has more promises to make, and also to what extent the global trends are shaping and directing the trajectory for the passive investing in India? Is it some lesson to learn from the global market, Mr. Pathak?
Yeah. So I think Shravanji very rightly said that the fortunes of different sectors will keep on rotating. So there will be times when high quality, low volatility stocks or indices will do well. There will be times when the cyclicals will do well. There will be times when. So I think these decisions of asset allocation will have to be made on size and style and trends, and based on that, I think last 2-3 years the cyclicals have done much better than defensives. Value has done better than growth, but it is too soon to say that growth is behind us and it is only value which will do well. So I think one will have to have an open mind, but see how the prospects and the valuation. So if PSU stocks were available 5 times earnings, they gave a different prospective return prospect. If they are now available 50 times earnings, what will happen to my future returns? So will I be able to get those? So if the re-rating has happened very dramatically in one area and there is a de-rating in another area, I think at some point the cycle turns, and some understanding of the cycle clock of investing, where inflation and growth and recovery and recapitalization of the market happens, will be required from an asset allocation standpoint. Within that, whether it is better stock picking which will give more returns, or whether it is more sectors which will give a better return, is a difficult choice. And I'm sure even within a plain vanilla index, the weightage of one sector which is doing well will go on rising. So to that extent, I think it's premature to say that let's focus on this kind of a sector stock. Second aspect which you pointed out is what are the lessons
from the global market, right?
The global market, and within that, especially the US market, because US market is the mother of all stock markets, the way one sees it. So there are two things to keep in mind here. I think passive and ETF are two words which are interchangeably used, which is not right. In US, you have a very large number of ETFs which are active. And one of the examples which I can give is the ARKK ETF. It is created by Cathy Woods, and it had a dream run since 2015, and it was a nightmare after 2021. So all ETFs are not passive. There can be active ETFs in the US. So I'm sure as we try to pick up more and more trends, some of these trends will come into India as well. Second thing is passive index funds versus passive ETFs. And when we talk about passive, we go to the the biggest contributor to this area has been Jack Bogle of Vanguard. And he says ETFs is not a good idea. He says passive index funds are better because in ETFs, you are likely to trade much more. And when you trade, you're, like I said, you can be an active investor in a passive instrument. So that trading will rob you of many of your returns. And you are trying to be smarter than the market. So you want to sell before the next correction, and you want to buy the dip, and you want to ride the. So all this smartness goes counterintuitive to wisdom. And so Jack Bogle says that ETFs is not a good idea. Passive index funds is a better idea, where you buy and hold for a long time. And I'll just finish this with a little in lighter vein, that passive investing in active funds. Fidelity ran a study in the US that which were the folios which had the best returns. And when they identified those folios, they realized that they belonged to investors who were dead and had not claimed those assets.
I saw
So
it
just,
somewhere. You're right.
yeah, just by the fact that they passively held these funds, active funds, over a long period of time, they created huge wealth. So, I mean, take it in a little lighter vein, but I think ETF and index funds and ETF, if you are looking at trading, then whatever cost you save on the management fee, you will drain much more cost by way of the market maker's cost, the brokerage, and your calls going right, you sitting out when the market goes up and you entering when the market is already high and then suffering a drawdown. So I think trading will far outweigh whatever saving you make from the passive strategy. I may be a little blunt, but I think it is important.
Fair point,
especially
fair point, Mr. Pathak. I think you have,
yeah.
you've really hit the nail on the head, and that is what it's the main genesis of wealth creation is holding it for a longer time. And the example which you give is very prominently used that people who died, the holdings had made maximum money. Just to share, one reference that we were in a conference, and the HDFC MD, I'm saying the HDFC Mutual Fund MD, Mr. Munot shared that one of the fund had fabulous return in last 3, 4, 5 years. I would not like to name here, but the key point was that how many investors made that return. And when they started looking at the folios, people who had stayed invested since they invested, the number were not in triple digit as well. That's very, very important message from Mr. Pathak that, where do you really make money is to stay and hold on. And that's what passive really makes that difference there. Thank you, Mr. Pathak, for that, elaborate sharing of your thought on that. Coming to Mr. Goel, and as we're just speaking, right, that, it is Kathy Woods, which is the head of ARKK, and from 2015 to 2000, roughly around 22, right, made fabulous return, created huge amount of wealth. But today, in the same breath, people are talking about the biggest wealth destroyer is Kathy Wood, right? Now, this is where the change in the strategy, right, clearly is there. And that was not completely passive, but, a smart beta fund which she runs, right? Coming here, I'm just showing for the new investors or maybe for the existing investor, is there a particular strategy which really makes a difference where, he can seriously feel the difference, right? And can get a benefit out of it. And second, if you look at what are the common misconception or maybe the, the general myths people have about investing in passive, could you please share your thought?
So I would say from investors' longer term journey, time in the market is more important than timing the market. Typically, all of us try to time the market, that we want to invest when markets are down, but the cost of that is we are sitting out for very long period. If we try to buy markets at lower level, so market may not fall for next 2-3 years. Who knows, right? So rather than timing the market, one should invest in equity markets from longer term perspective, because in last 10, 20, 30 years, had you invested and compounded your wealth at 12 to 15%, then longer term wealth creation, the power of compounding is huge. So one should not get swayed by shorter term trends, and one should stay invested in equity markets from longer term perspective, right? And second misconception, typically people say that passive funds don't generate alpha, right? Why? Because the role of any passive fund is to generate market returns or generate return which is very close to the benchmark return. So passive funds are not attempting to outperform the benchmark. They are not taking active calls of investing outside benchmark or in a different proportion as compared to benchmark. So which means that the passive funds returns would be very close to the benchmark return, subject to expense ratio and tracking error. So in the long run, for example, if you invest in Sensex or Nifty based ETF, your return will broadly track a Nifty or Sensex index, total return index, subject to expense ratio. If the underlying benchmark is generating, say, 15% return, your return would be 15% minus expense ratio, which could be 10 basis point lower than that. So which means in the long run, if you are investing in any ETFs, you are generating returns which are close to market return. So ideally, young investors should start their journey by investing in broad market cap based ETF or index fund. Why? Because when you are new to investing, you don't understand the nuance of complex investing. So you should start experiencing in equity investing by way of investing in plain, simple to understand, simple to understand market cap oriented funds such as Nifty ETF, Sensex ETF, Nifty Next 50 in the ETF. As and when you believe that you have understood some of the nuance of investing, and if you believe that markets are trading at attractive valuations, mid caps are trading at even more attractive valuation, at that point in time, you can increase allocation towards mid cap and small cap. Or if you believe that certain sectors are offering good value, in the sense they are trading at attractive valuation, because in the long run, generally market follows, market is slave to earnings growth. So whatever earnings or profit corporate India is generating, generally long-term equity returns would broadly track that. So say if GDP growth rate of India will be around 6 to 8% with 4 to 5% inflation, which means that nominal GDP growth would be about 11-12%. So broadly, market returns would be more or less in line with that, plus minus 1-2% based on whether the organized sector is gaining market share as compared to unorganized sector, right? So longer term market returns would be broadly in that range. At times, market will deliver higher return because if earnings growth starts improving and valuations are attractive, at that point in time, markets start delivering higher return. But you should not get swayed by recent return. So if, for example, last 1 year, markets have generated 20, 30, 40% return, you should not expect similar return in the next 1-2 years, because generally market has tendency to revert back to mean valuation. So you should always understand that longer term market returns would be broadly 12 to 15% range, and your expectation should be in line with that. And I would say one should not get swayed by what has worked well in recent past. As Mr. Pathak also mentioned that markets keep shifting from one style to another style. So at times quality performs well, at times value performs well, at times certain sectors are performing well, another time different sectors are performing well. So you should not be chasing funds which have done exceedingly well in recent past, because these funds have their own cycle, and you may get caught in the wrong cycle. So young investors should approach market from longer term perspective. They should start with plain vanilla, easy to understand market cap oriented ETFs such as Nifty, Sensex, or Nifty Next 50, these kind of funds.
Thank you so much for busting a couple of myths. I think very, very important. And for especially new set of investor, those myths are something which is a misguiding factor. Thanks. Thank you so much, Mr. Sarwar. Now coming to Mr. Pathak, in your 40 years of experience, I'm sure, it's one of the rare we see in India who has seen the markets, up and down. And also, as you see yourself, that a fair bit of understanding of how you have been managing investors and what they feel, what they understand. From that perspective, right, if you look forward, how do you envision the evolution of passive investing in the investors' portfolio in India over the next 5-10 years, right? Where do you see that? And secondly, are there challenges which you see or some roadblocks in our growth or movement towards this journey? Mr. Bharat Pathak.
Yeah. So, as a core belief, we believe in active management. And like I said, we see that there is still a headroom of 10-15 years in which before the penetration goes to such a level that most of the industries, most of the investments are done by institutional investors. Then it will become really very difficult for active to outperform. But I think there is that headroom of next 10-15 years in which, while the advantage will gradually reduce, there is a case for active investment to start with. So if you were to ask me, I'm tilted in favor of active investment, and that is what we believe in. So 70% in favor of active investment is how I'll position myself. Second aspect, obviously, we talk about risk and risk in passive investment being less. But we also have to keep in mind that sometimes pure passive investment can create a risk of a bubble in the market. Because what happens is, I mean, you look at the S&P 500 in the US, and people argue that there are two S&Ps there. There is S&P 7, which is the Magnificent 7, and there is S&P 493, which is not
Very interesting observation.
participating in that. But what happens is these are market cap weighted indices. So it becomes a self-fulfilling prophecy where if my market cap goes up, my allocation goes up. Market cap goes up, my allocation goes up. And then it can come to haunt you at some point of time, or it can create a bubble, because when everybody is a passive investor, you are putting money in something whose market cap has been going up in a blind fashion, and it can create some sort of a bubble in some areas in the market. So I think it is important to keep that in mind and not be under an impression that passive will always be risk-free. There is nothing risk-free, and passive versus active, at least I mean, we should not look at passive as a magic wand here. But at some point, the ability of fund managers to beat the index will become less and less. So that is a point which we have to keep in mind. Secondly, we talk about asset allocation and rebalancing. And if I want to have a particular part of my portfolio dedicated for rebalancing, then it does not make sense to have that part in an active strategy. So that part, I think, clearly belongs to a passive strategy. So if I say, I'll give you some simple example that if I'm a 50-50 stock and bond allocation, and within that, market goes up, I take away and rebalance to 50-50. Market goes down, I take away from the bond side and rebalance to 50-50. If we look at the typical stock market movements over a long period of time, with the exceptions of the global financial crisis, or with the exception of the COVID crisis, there is a 10-12% movement which typically happens around the mean in the market. And hence, even for my 50-50 allocation, I can say that 40% I will have in active strategies, and 10% I can still have in passive strategies, because there I'm saving on costs, I'm saving on any exit loads, and I can rebalance very easily because they are in the active part, and they are in the passive part and low cost. The 40% active, I will have a different reason to make changes in that portfolio, depending upon, like I said, the style, size, and trends, which, with whatever baggage of history you think is likely to work. And lastly, you talked about the 40 years of experience. So they say good judgment is the result of experience, but experience is the result of bad judgment. So you make your judgments and
No, thank you so much.
Yeah,
for
but you
beautifully
know,
explained.
Saket, you know, while Bharat is alluded to, kind of the experience I have, but Sharvad, I think we'll also kick in here a little bit, because I don't think so. There is index or passive investing can create a bubble. But if that had been the case, today you have a global market that is 11 or trillion dollars worth of assets, and you have more than 11,000 odd products. The US market has almost 54% of its whole assets moving towards passive. So I think it would really cut a very wrong picture to a developing market such as ours to say that passive builds out a bubble, because that's definitely not the case. And Sharvan, like I said, you can definitely push, share your perspective, because you're definitely on the side where you are creating these products and you have investors who are coming in and giving you assets, right? So that's very, very critical. Today India is at just 17% of the total assets that are there. If we look at the amount of investors today who are putting into fixed deposits, where you are getting 6 to 7%, not even that much, and look at the inflation, which is around 4 to 5%, your net return is so minimalistic. A lot of the people who are investing into fixed deposits don't even know that their net return is that minimalistic. If they had to put that same a surplus into market related, then the kind of returns that they would generate for their own investment goals would be so differentiator. And while talking about risk, Bharat, I completely agree with you. I mean, there is risk crossing the road today. There are people who have crossed the same road multiple times, but there could be that one time that something comes and hits you. So there is risk in everything in life. So let's not talk about risk and if somebody, but this is about passive investment is taking a very informed decision into exposing yourself and kind of flavoring yourself with the market. The whole theory of a lot of people that I don't understand markets, I don't understand stocks. For people who don't understand stocks, you don't have to understand stocks. There is an index that has been created by a professional and is being run by a professional fund management product. So it is just that simplistic tool, and that's why passive investment is that avenue to have a very, very simplistic access. Today you have a huge amount of investments coming via EPFO, but that's not the only reason that's driving our markets. There are fundamentals, there are company valuations, earnings, and there is a lot of retail, there is a lot of FIIs, there are institutions who are all participating towards making our economy and our markets grow. So it can't always be, it can't be an index that will drive market capitalization or will
Maxwell.
drive the market upstairs. So, but
Mr. Goel,
I would definitely, Sharvan, if
So-
you can add. Yeah.
Can you
Yeah.
just put
So
your
while
take on this?
adding to
Interesting.
what you mentioned, that both active and passive plays its part in long-term wealth creation journey of any investor. And a new investor who is new to markets, passive funds are easier to understand because that on day in day out you understand that Nifty, Sensex, which are having 20, 30, 40 years history, and you know how these indices have performed in the long run, right?
Yeah.
So these are simple to understand, effective solutions to begin with. Once you understand the nuance of equity investing, you can choose to
Diversify
invest,
and
diversify across active and passive based on your belief that I want this style should do well. So within that style, there are both active and passive funds are available, right?
Correct.
So there are merits for investing in active and there are merits for investing in passive funds. So one should not feel that these are competing with each
Right.
other.
It's not
For
watertight
any
compartment.
both
Yeah.
plays a big role for long-term wealth creation journey of the investor.
Fair point. Thank you. And just to add to Coel, what she was saying, the biggest risk is not taking any risk. That's again very, very important that, when you look at, I think Mr. Goel said that, 15 to 20 year return in the biggest benchmark in the country is 15%, right? That's not a small number for such a long duration. That itself reflect what could be the, promise which is there, right? And this is seen, last 20 years has seen almost everything. You had, collab government, which was, not of this majority or all kinds of things we have seen. So clearly that shows that, why are you really trying to, jump, hop here and there from this fund manager, that fund, this strategy, that's just stay invested in one and just reap the return. Right. I'm just quite tempted to ask Mr. Bharat, I think one very important question, which he just shared, that at this point in time, he's looking 70, active and 30 passive. So what will your, construct be after 5 years? Just to understand for our entire investment.
What I mean to say is I'm not 100% in favor of active.
Sure.
I'm 70% in favor of active, 30% in favor. So, I mean, it is a way you look at probabilities or look at, so that is the way of, giving a weight to my decision. That is how.
Thank you. Thank you, sir. Thank you so much. I think we have come to the end of the questions. Thank you so much. We'll just take the participants' question if they have. I think there are two questions which I'm seeing which has come up. Let me first take the first one. How is an index fund different from an ETF? Which is better for investment? Anyone who would like to answer?
Sakit, see, ETF and index fund offers you two types of passive investing. So in the sense, they are the way you are investing. So for a passive fund manager, aim is to replicate the benchmark. Whether you are investing in ETF or index fund, as a fund manager, I will try to replicate the benchmark. So for example, if you are investing in Nifty ETF or Nifty index fund, job for passive fund managers is to generate returns, which is in line with the benchmark. But ETF or index fund is the way you invest. In case of ETF, you are investing through secondary market, which is just like the way you are investing in stocks. The mode of investment is same for ETF. But index funds are more like traditional mutual fund schemes, which is most active funds, wherein you are investing in a mutual fund scheme and getting day and NAV. So advantage of ETF is you can take advantage of intraday price movement in case of ETF, and you need demat and trading account whenever you want to invest in ETFs. So so you have to understand the overall cost of ownership whenever you are investing in ETF, because index funds are bundled product wherein there is no additional cost apart from total expense ratio, which is charged by the AMC. Total expense ratio includes management fees, any R&T charges, index fees, or custodian charges, right? But in case of ETF, apart from total expense ratio, there could be additional cost in the form of demat account charges, trading account charges, and whenever you are investing in through secondary market, there could be some impact cost, right? So you have to understand the overall cost of ownership. So typically, overall cost of ownership for ETF could be slightly higher if you are trading in ETF, because every time you buy and sell ETF, you are paying the trading cost as well. So one should invest in ETF for slightly longer term horizon, because if you are investing in ETF for more than 2 years, then you are covering that additional cost, which you are paying by way of trading and demat charges.
Thank you. Mr. Bharat, you wanted to share something. Please go ahead.
Yeah. I'd like to add here something. I think ETF, you will need willpower to stay invested. And it is important that you change the environment rather than try to tax your willpower. I'll give you an example. If I want to study, I should go to the library, not to the disco. If I want to dance, I should go to the disco, not to the library.
Aptly put it. Thank you, Mr. Bharat. Those simile is wonderful. The next question is directed to Mr. Savan. Since he has taken it, I would request the other two panelists. The question goes, Mr. Savan mentioned that there are different strategies which works at different period and markets. So if one wants to invest for a period of 10 to 15 years, how and which fund should I select? Very different, since I am not from the financial background. Very difficult for me since he's not from financial background. Yeah, who'd like to take it between Mr. Bharat and Koel? Anyone of you can.
So, Mr. Bharat, since you're the advisor, then you should be advising here, because we are not the advisors here.
Yeah. So I think if you're a investor who wants to buy and hold, you should go into a broad-based fund and hold for a long time. The sector rotations, etc., will keep happening. But if you're going to hold it for 10 years, you should go in a broad-based fund, especially because you are not equipped to make those choices of exiting one sector fund and entering another sector fund. And that is a choice which even most professional managers will find it very difficult to make. So if you make a combination of the Nifty and Nifty Next ETF and just sit on it for 10 years, I think all the rotations you will be able to digest. So it is 10 years which makes the money, not the sector rotation which will make or lose the money. Here I'm tempted to tell you a story about Warren Buffett. And in 2008, Warren Buffett made $1 million bet with a hedge fund of fund managers. And he said that the Vanguard Admiralty, the fund which is Admiral's fund, which is the lowest cost index fund, over the next 10 years will outperform the fanciest of fund of hedge funds, which the other manager was running. And they said, we'll both of us set aside $1 million each, and whoever loses will give that $1 million to charity. And before 10 years were over, the like in a chess match, the hedge fund manager surrendered because the Vanguard fund had scored 7.5% gains, whereas his fund, the smartest hedge fund, had scored 2.7% gain over a 7 or 8 year period. So he said, I resign and I'll give that money to charity. So uh, for a even for the expert of experts, making these calls is very difficult. So I think go in a broad-based uh, fund and hold it for long term. I think that is the main takeaway, and that is the reason I'll say not ETF but index fund.
That's
I
lovely
completely
story.
agreed. I think long term is the key, but I think to, also to, Bharatji's profession, very, very important to talk to financial advisors because, at this point of time, Bharatji doesn't know what your age is, at what financial stage you are, and, kind of that advising forms a holistic part of financial planning. So, for any new investor or somebody who's planning, it's always good to take advice from registered or professional financial advisors because they look at your financial planning in a very, very holistic manner and take all your commitments, your life stage, where you want to achieve and what you want to achieve into account, and thereafter give the advice. But I agree with you, Bharatji. It's long term is the keyword.
Yeah.
Just to add to that, what Mr. Bharat said, that there's a big learning out there, and Charlie Munger, who recently died, and also Warren Buffett, they've gone ahead and on the record to say that it's extremely difficult to beat S&P 500, right? And that's what in advice to, I think, the Warren Buffett's wife, that if I'm no more there, invest your money there. So that's something, a big statement coming there. With this, I would like to close the entire session. A heartful thank to our esteemed panelists for sharing their wealth of knowledge, especially I think both the gentlemen, Mr. Bharat for his 40-year rich experience, sharing in just 20 minutes with such beautiful examples, and I think Shravanji for his entire understanding and realistic sharing of how one can burst the myths which is there prevalent as far as passive investing goes, and how one can add to all aspects of strategies when you have to create a good portfolio. And thanks to Coel for nudging around that it is very imperative for your portfolio that you inherent risk. Without risk you cannot reach anywhere. Thank you, gentlemen. Thank you so much for this lovely evening and lovely session. It has really helped all our participants and all of us. For that, I think would like to really thank you for your presence and sparing invaluable time. Thanks a lot. Thank you so much.